Swing Trading. Chapter 7. Momentum Swing Trading. Relative strength compares a stock's performance with a benchmark like the S&P 500 or NASDAQ 100. That comparison matters because a stock can be going up and still be a weak momentum candidate if the broader market is doing even better. Momentum traders are not just looking for stocks that are rising, they are looking for stocks showing leadership. Strong relative strength tells us demand is concentrated in that name more than in the average stock. That makes it especially useful when building a watch list, because it helps narrow attention to likely leaders instead of laggards. In practice, relative strength is one of the fastest ways to separate up from truly strong. Momentum often persists, which is why traders care so much about relative strength. When a stock is already outperforming, it suggests buyers have been willing to keep stepping in over days or even weeks. Those leaders often continue leading for a while, especially when the market environment stays supportive. Even when the market softens, strong relative strength stocks may hold up better because they already have stronger sponsorship behind them. That does not make them risk-free, but it does improve the odds that you are focusing on stronger names. For momentum swing trading, relative strength helps you follow where money is already flowing. A rising stock is not automatically a strong stock. Context matters, because the real question is whether that stock did better than the market over the same period. If a stock gained 20% while the market gained 25%, the stock still underperformed even though the chart may look impressive by itself. On the other hand, a stock that gained only 8% may actually show stronger relative strength if the market rose just 2%. This is an important mental shift for swing traders. We are not rewarding raw gains alone. We are looking for outperformance. That is what identifies true leadership. One simple way to track relative strength is by dividing the stock price by the index value. The exact result, like 0.075 in this example, is not what matters most. What matters is whether that ratio is rising, falling, or going sideways over time. A rising RS line means the stock is outperforming the benchmark. A falling line means it is losing ground relative to the market, even if price itself may still be advancing. This is why traders focus on the trend of the RS line rather than the raw number. The direction of that line tells you whether leadership is improving or fading. Many platforms simplify this work by giving stocks an RS rating, often on a scale from 1 to 99. A rating of 90 generally means the stock outperformed 90% of stocks over the look-back period. That makes RS ratings a useful first filter, especially when your universe is large. Many traders start paying attention around 80, and they become even more interested when a stock is above 90. Still, a high rating is not a buy signal by itself. It is a screening tool that helps you find leadership candidates quickly. After that, the chart still has to justify the trade. On a chart, strong relative strength usually looks best when it is paired with healthy price structure. Ideally, the RS line is trending upward while the price chart is forming higher highs and higher lows. That combination tells you the stock is not only beating the market, but doing it in an orderly way. Smooth advances tend to be more attractive than wild, erratic moves because they are easier to manage and often reflect steadier demand. By contrast, a flat RS line with choppy price action suggests there is no clear leadership edge. For momentum swings, the strongest candidates usually combine rising relative strength with constructive trend behavior. Relative strength tells you what deserves attention, but it does not tell you when to buy. A stock can have excellent RS and still be too extended to enter safely. That is where many traders make the mistake of chasing simply because the stock looks powerful. A better approach is to use RS for stock selection. Then wait for an actual setup such as support holding a controlled pullback or a breakout with volume. In other words, strong RS answers the question of what to watch, not whether this exact moment is the right entry. Separating selection from timing helps keep momentum trading disciplined. A simple RS review process makes this concept practical. Start by choosing a benchmark that matches the stocks you are reviewing, such as the S&P 500 for broad, large-cap names, or the NASDAQ 100 for more tech-heavy names. Then check whether the RS line or ratio is trending higher over time. After that, use RS ratings to narrow the list to the strongest candidates. Once a stock passes those filters, shift your attention back to price action and wait for a favorable setup. This workflow keeps you from jumping too early and turns relative strength into a repeatable tool instead of a vague idea. Consider a simple example using Apple. If the S&P 500 is up 2% over the month, Apple is up 5%, and a competitor is up only 1%. Apple is clearly showing stronger leadership. If Apple's RS line is rising while the competitor's is flat, that strengthens the case even more. A high RS rating like 95 tells you Apple belongs on your watch list because it is outperforming both the market and its peer. But even here, discipline still matters. If the stock is extended above support or stretched after a strong run, you wait. Strong relative strength can identify the leader, but timing still comes from the chart setup. There are a few common errors that weaken the value of relative strength. One is buying solely because the RS rating is high, without checking whether the stock is extended or whether the market environment supports the trade. Another is confusing positive performance with outperformance, which can lead you into stocks that are rising but still lagging the benchmark. Traders also run into trouble when they use too little history and let short-term noise distort their judgment. And even strong RS stocks can fail if the overall market is deteriorating or if the move has already become extreme. Relative strength works best when it is used with patience, context, and risk control. The key takeaway is simple. Use relative strength to find potential leaders, then let the chart determine whether you act. A good practice exercise is to screen for RS ratings of 85 or higher. Compare those names with the S&P 500 and study whether the RS line is still rising or starting to stall. At this stage, the goal is not to place trades. The goal is to train your eye to recognize leadership clearly and consistently. This helps separate stock selection from entry timing, which is one of the most valuable habits a momentum swing trader can build. With that foundation in place, we can shift into timing tools, beginning with RSI. RSI, or Relative Strength Index, is a momentum indicator that compares recent gains with recent losses. It plots on a scale from 0 to 100, which gives traders a quick visual read on how strong recent price movement has been. The standard setting is 14 periods, so on a daily chart it usually reflects the last 14 trading days. Higher readings suggest stronger recent upside momentum, while lower readings suggest stronger downside momentum. What RSI does not do is predict the future with certainty. It is a tool for judging momentum conditions, and in swing trading that makes it especially useful for timing rather than forecasting. Most traders first learn RSI through the Overbought and Oversold labels. Readings above 70 are often called Overbought, and readings below 30 are often called Oversold. Those labels are useful, but they are also easy to misinterpret. Overbought does not mean price must immediately fall, and oversold does not mean price must immediately bounce. In reality, those levels often tell you that momentum has been very strong in one direction. For swing traders, the goal is not to treat RSI as an automatic buy or sell switch. The real value comes from understanding what those readings mean inside the trend. RSI fits swing trading best when it is used as a timing tool inside an existing trend. In an uptrend, it can help you recognize when momentum has cooled off and is beginning to rebuild. In a downtrend, it can help you spot when a bounce is weak and the larger decline may resume. That is why RSI works better with price structure than on its own. A strong signal comes from the combination of trend, support, or resistance and a momentum turn. If you isolate RSI from the chart, it becomes much less reliable. Used in context, it can help you avoid chasing and improve your entry timing. A higher probability long setup usually starts with a stock already in a clear uptrend. Often, RSI first pushes above 70 during a strong rally, which tells you momentum has been intense. But instead of buying that first surge, many traders wait for a pullback that does not break support. As price retraces in a controlled way, RSI may cool back toward the 50 to 60 area. If RSI then turns back up while price structure still holds, momentum may be rebuilding in the direction of the trend. That sequence is often more attractive than chasing the first overbought spike. You are buying after a reset, not at the most emotional part of the move. Think of the entry as a sequence rather than a single signal. First, confirm the stock is making higher highs and higher lows, because that tells you the trend is still bullish. Then note that RSI previously showed strength by pushing above 70. After that, let the pullback fully develop instead of guessing at the first dip. The entry becomes more interesting when RSI turns back up and price still holds above the recent swing low. At that point, the chart is showing both trend continuation and renewed momentum. A stop below the recent swing low gives the trade a clear invalidation point. The same basic idea can be flipped for short trades in a downtrend. Heavy selling can push RSI below 30, but that oversold reading alone does not mean the stock is a buy. Very often, a short rebound follows as sellers pause and some buyers step in. The key question is whether that rebound is strong enough to change the trend or weak enough to fail. If the bounce loses momentum and the stock rolls over while lower highs remain intact, that can create a short setup. In that context, oversold is not a reversal signal. It is simply one part of the momentum story inside a larger bearish trend. Suppose tech wave rallies from $40 to $55 and RSI reaches 78. That tells you momentum has been strong, but it also warns you not to chase the stock at an extended point. If price then pulls back to 52 while RSI drops to 55, the move has had a chance to cool off. If support holds and RSI turns back up from 55 to 57, that suggests momentum may be rebuilding without the trend breaking down. An entry around 52. 50 starts to make more sense than buying at 55, with a stop at 49. 50. The trade has a defined risk point beneath the recent structure. The lesson is that RSI helped time the entry after strength reset rather than encouraging a chase. What made that example work was alignment. The entry did not happen when RSI first moved above 70, because that was the moment of greatest extension. It also did not happen simply because RSI dipped, since a dip by itself does not prove momentum is returning. The trade became more compelling when RSI turned back upward, while the uptrend structure remained intact. That combination gave the chart a chance to resume rather than just react. The later exit around 58 shows the benefit of waiting for a cleaner setup instead of forcing the first move. Good RSI use is less about speed and more about timing with context. RSI becomes much less effective when traders ignore context. A common mistake is buying just because RSI falls below 30, even when the stock is in a clear downtrend and still under pressure. Another is ignoring the broader trend completely and treating every RSI move as equal. Very short RSI settings can also create noisy, unstable signals that look precise but are not especially useful for swings. Traders also get trapped buying the first drop after RSI was above 70, assuming a pullback automatically creates value. And of course, skipping the stop-loss turns even a decent setup into a poorly managed trade. RSI can help with timing, but only if discipline stays attached to the signal. A good way to practice RSI is to study it in context rather than hunting for perfect signals. Choose a stock that has been in an uptrend for at least several weeks, then record the current price and the 14-period RSI. Classify the reading, above 70, between 50 and 60, or below 50. Then ask what on the chart still supports the uptrend, such as higher lows or price holding a support area. After that, simply watch for a pullback and an RSI turn upward before imagining an entry. This kind of repetition builds judgment, which matters far more than memorizing thresholds. From here, we can add another momentum confirmation tool, the MACD histogram. The MACD histogram gives you a simple visual way to read momentum changes. MACD itself has three parts: the MACD line, the signal line, and the histogram. The MACD line reflects momentum by comparing faster and slower moving averages. The signal line is a smoother average of the MACD line, which helps create a reference point. The histogram then shows the distance between those two lines as bars, making it easier to see whether momentum is expanding or contracting. For swing traders, that visual shortcut can be more intuitive than watching two lines weave around each other. Once you understand the bars, the histogram becomes very readable. Bars above 0 suggest bullish momentum, while bars below 0 suggest bearish momentum. If the bars are growing taller, momentum is strengthening in that direction. If the bars are getting smaller, momentum is fading even if price has not reversed yet. This is useful because it helps you focus on acceleration or deceleration rather than just price alone. The histogram is not predicting where price must go next. It is simply showing whether momentum is building or losing force right now. A key event on the histogram is the zero-line crossover. When the bars move from below zero to above zero, that is a bullish crossover and suggests momentum has shifted upward. When they move from above zero to below zero, that is a bearish crossover and suggests momentum has shifted downward. For swing traders, that shift can act as confirmation that a pullback may be ending or that a decline may be resuming. One important detail is to wait for the bar to close before acting. Intraday moves can briefly flip above or below zero and then reverse by the end of the session. The close gives the signal much more reliability. A histogram crossover is much more useful when it agrees with the broader price trend. Before focusing on the indicator, check the recent 20-day structure of the chart. In an uptrend, you want to see higher highs and higher lows, and bullish crossovers tend to carry more weight. In a downtrend, lower highs and lower lows make bearish crossovers more relevant. This keeps you from taking every signal mechanically. The indicator is most helpful when it confirms what price is already suggesting. Trend gives the crossover context, and context is what separates better setups from noisy ones. The application process can stay very simple. Start with the standard MACD settings of 12, 26, and 9, so your chart matches the common reference traders use. Then determine the 20-day trend before doing anything else. After that, wait for a histogram zero-line crossover that points in the same direction as the trend. If volume is above average when that crossover appears, the signal deserves more attention because it suggests stronger participation. This does not mean volume is required every time, but it can improve confidence. The goal is not just to find a crossover, but to find one that has trend and participation behind it. Even a strong momentum signal still needs a full trade plan. If the crossover is bullish and agrees with the trend, a common stop goes below the recent swing low. If the crossover is bearish in a downtrend, the stop usually belongs above the recent swing high. Those levels matter because they mark the nearby structure that should hold if the trade idea is correct. On the exit side, you can leave if momentum fades, if the histogram reverses, or if your price target is reached. The exact method matters less than having one before you enter. A disciplined setup always includes entry, risk, and exit planning together. Imagine Omega Tech rising from $40 to $46 over 3 weeks. During a pullback, the histogram stays below zero, showing that momentum cooled while price retraced. Then the bars cross above zero at positive 0.12, and that shift happens with strong volume. This is the kind of signal momentum traders prefer. Because the trend is already up, momentum is turning back in the trend direction, and participation supports the move. An entry around 45.50 with a stop at 43.50 creates a clear, structured plan. The point of the example is not the indicator alone. It is the alignment of trend, crossover, and volume that makes the setup stronger. In this example, price rises to 48.20 over the next 3 days, confirming that the momentum shift had real follow-through. As the move continues, the histogram bars begin to shrink, which is an early sign that momentum is no longer expanding. When they eventually turn negative, the original bullish thrust has clearly faded. Exiting around 48 captures most of the move while respecting the indicator's message. That creates a gain of 2.50 per share, or $250 on 100 shares. The lesson is that momentum indicators can help not only with entry confirmation, but also with recognizing when the move is losing energy. Histogram crossovers become much less reliable when the market is choppy or directionless. In sideways conditions, the bars can flip above and below zero repeatedly without price making meaningful progress. Signals that go against the prevailing trend also tend to fail more often because they are fighting the broader structure. Weak volume is another warning sign, since it suggests low conviction behind the apparent momentum change. Late entries can create problems too, because even a correct signal may leave too little upside compared with the risk. The indicator is useful, but only when the surrounding context makes the signal tradable. To practice this tool, find a recent bullish crossover on a stock chart and write down the price, the trend direction, and whether volume was above or below average. Then ask a simple question. Was this setup actually worth trading, and why? That forces you to judge the signal in context rather than treating every crossover the same way. For extra practice, compare it with a bearish crossover and look at how trend alignment changed the outcome. Over time, this builds pattern recognition. And that is the real goal with MACD histogram work, not memorizing bars, but learning which momentum shifts deserve action. With that in place, we can move to another continuation style tool, stochastics. Stochastics adds something slightly different to a momentum entry. It helps you judge whether price is merely rising or whether it is accelerating with stronger pressure behind it. For swing traders, that matters because we often want continuation, not just a temporary bounce. A stock drifting upward can still stall easily, but a stock showing a true momentum surge may have enough force to carry further. Stochastics can help confirm that difference. It works best when the broader trend is already healthy and the indicator is being used to refine timing, rather than to create a trend where none exists. The stochastic oscillator compares the current close with the stock's recent trading range, usually over 14 periods. It also runs from 0 to 100, which makes the reading easy to interpret at a glance. The faster line is called %K, and the slower, smooth line is called %D. A common default setting is 1433. When the close is near the top of the recent range, the indicator moves higher. When the close is near the bottom of the range, it moves lower. In short, stochastics tells you where current price is sitting relative to recent trading behavior. In classic technical analysis, readings above 80 are called overbought and readings below 20 are called oversold. But in momentum trading, overbought needs to be interpreted differently. A stock in a strong trend can remain above 80 longer than many traders expect. In that environment, an overbought reading can actually reflect persisting demand rather than an immediate reversal risk. This is why strong trending stocks can keep climbing while the oscillator stays elevated. If you automatically assume overbought means sell, you may miss some of the best continuation moves. In momentum trading, the question is not just whether the indicator is extreme, but what that extreme means in context. The higher quality long setup with stochastics is a bullish crossover that happens in overbought territory. Start with price already in a clear uptrend because the indicator works best as a continuation tool. Then wait until both %K and %D are above 80, which tells you the stock is already showing strong upside pressure. The actual entry signal comes when the faster %K line crosses above the slower %D line while both remain above 80. That suggests momentum is not just strong, but reaccelerating inside the trend. In other words, buyers are regaining control after a brief pause. This is a very different idea from buying a weak stock just because it looks oversold. This tool also gives you clear warnings about when to avoid or exit. If %K crosses below %D while both are still above 80, that can be an early sign that the momentum surge is fading. Once either line drops back below 80, the continuation case becomes weaker. That does not always mean price will collapse, but it does mean the strongest part of the thrust may be over. Stochastics also tends to produce poor signals in sideways or downtrending charts, because there is no healthy trend for momentum to continue. The best use of the indicator is not to force entries, but to participate only when strength is still building. A simple checklist keeps this setup clean. First, confirm the stock is making higher highs and higher lows, because trend quality comes before indicator signals. Second, apply stochastics with the standard 1433 setting. Third, wait until both lines move above 80, showing that upside momentum is already strong. Finally, enter only when %K crosses above %D. That sequence matters because it keeps you from reacting to random oscillator movement. By evaluating trend first and crossover second, you stay focused on continuation rather than noise. Risk management still matters even when the indicator looks strong. Some traders enter near the current market price, while others use a buy stop just above price, so the stock has to confirm strength first. Either approach can work if it fits the chart. The stop usually belongs below the recent swing low, because that is the nearby structure the setup should respect if momentum is real. Very tight stops based on tiny fluctuations often get shaken out too easily. On the exit side, a weakening momentum reading, especially a rollover in the oscillator, can be a good clue that the surge is fading. The main idea is to define both the entry and the invalidation before the trade is placed. Take a sample trade where a stock rises from $450 to $520 in 3 weeks. On Tuesday, %K at 87 crosses above %D at 83, and both lines are already above 80. That tells you the stock is in a healthy uptrend and momentum is re-accelerating rather than starting from weakness. An entry at 532 with a stop near 558 below the swing low gives the trade room to work while still defining risk. Later, when %K falls back below %D above 80, the trade is exited at 569. This example shows the full sequence clearly: trend, crossover, entry, then momentum-based exit. The indicator is useful because it keeps each step tied to the chart's actual behavior. Most mistakes with stochastics come from ignoring context. Buying just because the indicator is above 80 is not enough, because overbought alone does not tell you whether momentum is still improving. Ignoring the broader uptrend is another major error, since this setup is designed for continuation in strong charts. Some traders also watch only %K and forget that the relationship between %K and %D is the actual signal. Holding after momentum clearly fades can give back a good move simply because the entry logic was not matched by exit discipline. Like the other tools in this chapter, stochastics works best when it is part of a full process, not a shortcut. A practical exercise is to find a stock in a clear uptrend and apply stochastics using the 14-3-3 setting. Mark a day when %K crosses above %D while both are above 80. Then study the next 5 trading days and ask what happened. Did price continue for at least a couple of sessions, or did the move fail quickly? Was the uptrend already obvious before the signal appeared? This kind of chart review teaches you where the setup works best and where it breaks down. Once you can recognize strong momentum on the chart, it becomes much easier to combine that momentum with another confirming factor: volume. Momentum tells you how quickly price is moving and in which direction. Volume adds another layer by showing how much participation is behind that move. A stock can look strong on RSI or MACD, but if very few traders are involved, the move may not have much staying power. On the other hand, when momentum and volume rise together, the move often carries more credibility. That is because price is not just advancing, it is advancing with broader participation. For swing traders, this helps separate fragile moves from stronger ones. Volume does not replace momentum, but it helps confirm whether momentum is believable. A volume spike means current trading activity is well above the stock's recent normal level. A common baseline is the 20-day average volume, because it gives you a practical picture of what normal looks like for that stock. Many traders start paying attention when volume reaches 1.5 to 2 times the average, and anything beyond that may stand out even more. For example, if a stock usually trades 500,000 shares and today it has already traded 2 million, that is a major increase in participation. The key idea is that volume is relative, not absolute. 2 million shares may be unusual for one stock and completely normal for another. Always compare today's volume with that stock's own recent history. The strongest momentum setups usually happen when price momentum and volume are aligned. Momentum tells you the move is happening, but volume tells you other traders are participating in it. When both are rising together, the setup generally has more conviction behind it. If price is accelerating, but volume is fading, the move may be vulnerable because participation is not keeping up. That does not guarantee failure, but it does call for more caution. In practical terms, momentum answers the question of speed, while volume answers the question of support. When both answers are strong, the trade usually deserves closer attention. A simple 2-step check can keep this process very disciplined. First, identify a clear momentum signal, such as a strong RSI reading, a growing MACD histogram, or a clean breakout in price. Second, compare current volume with the 20-day average. Ideally, the volume confirmation appears on the same day as the momentum signal or by the next day. If the price looks strong but volume does not confirm, it is often better to wait rather than force the trade. Acting only when both conditions align helps you avoid weak, low participation moves. This is one of the easiest filters a swing trader can add. When you read the momentum side of the setup, do not get trapped into searching for one magic number. RSI above 70 can indicate strong upside momentum, and RSI below 30 can reflect strong downside pressure. But those thresholds are just part of the picture. A growing MACD histogram can also show momentum strengthening, sometimes more clearly than RSI alone. The real goal is to judge whether momentum is clearly building in the direction of the trade. That judgment has to include market context, because a strong reading in a healthy trend means something different from the same reading in a chaotic move. The indicator gives evidence, not certainty. Your job is to decide whether that evidence is strengthening or weakening. Volume confirmation is strongest when activity expands right as the momentum signal appears. If volume is only near normal, the move may still work, but it carries less confirmation. When volume reaches 1.5 to 2 times average, it often adds useful evidence that participation is broadening. Larger spikes can strengthen the message further as long as the price action remains orderly. If volume becomes chaotic while momentum fades, the spike may reflect confusion or exhaustion rather than healthy demand. What you want is agreement, price moving well, momentum signaling strength, and volume expanding at the same time. That combination often marks the best quality setups. Suppose Solar Tech has a 20-day average volume of 400.00 shares. On a strong day, the stock rises 4%, the MACD histogram expands, and by midday volume has already reached 1.2 million shares. That means participation is running at roughly 3 times normal, which gives the move much more credibility. If a trader enters at 50 and later exits at 54, the trade is not just based on price rising. It is based on a combination of strengthening momentum and unusually heavy volume. That alignment is what makes the setup more convincing. The point is not that volume guarantees success, but that it helps confirm the move is real enough to deserve action. Not every strong-looking move deserves an entry. If green energy pushes RSI above 70 but volume is only 80% of average, the momentum signal lacks confirmation and may be worth skipping. If the stock then falls 3% the next day, that weak participation helps explain why the move failed to hold. The opposite problem also exists. Very high volume without strengthening momentum can be a warning sign of exhaustion rather than opportunity. News-driven spikes sometimes attract heavy selling even while volume looks impressive. So neither momentum alone nor volume alone is enough. The higher quality setups need both to point in the same direction. A few mistakes show up repeatedly when traders combine momentum and volume poorly. One is acting on momentum without checking whether volume actually confirms the move. Another is trading on volume alone, even when price and indicators are not showing real strength. Using a very short volume baseline can also create misleading comparisons, because the baseline itself becomes unstable, and many traders chase several days after the spike, when the best part of the move may already be gone. A better habit is to compare volume with a stable recent average and act near the actual signal, not long after it. Good setups usually look obvious in both momentum and participation at the same time. A practical decision rule is to ask 2 simple questions before entering. First, is momentum clearly strengthening in the direction of the trade? Second, is volume meaningfully above normal for that stock? If both answers are yes, the setup deserves your attention. If momentum looks good but volume does not confirm, the reliability of the move drops. If volume is high but momentum is not strengthening, reversal risk may actually be higher than it appears. This kind of rule keeps you from forcing trades just because one piece of evidence looks exciting. Often the best decision is patience until both parts line up. A momentum fade happens when price still looks strong on the surface, but the force behind the move is weakening. The stock may still be near recent highs, which is why these setups can be tempting. But if buying pressure is fading, progress often slows, stalls, or becomes much harder to sustain. For swing traders, that usually means the easy part of the move has already passed. At that point, the upside may be smaller, while the reversal risk is larger. Learning to recognize this early is just as important as learning to find good entries. Staying out of a weak late-stage move is often a winning decision. Late entries are dangerous because momentum trades depend on urgency, participation, and a believable reason for the move to continue. When those qualities begin to weaken, you may be buying close to the end rather than near the beginning. Fewer buyers are still willing to push the stock higher, and sellers may start absorbing demand near the top. What looks like a harmless pause can quickly turn into a more meaningful reversal. This is why chasing a stock after a big run often feels harder than expected. The chart may still look strong, but the trade quality has already deteriorated. Good momentum trading is not just about finding strength. It is about finding strength early enough to matter. Healthy momentum usually leaves clear evidence on the chart. Rising, or at least strong volume, shows that participation is still present. Active buying means traders are still willing to step in and support the move, rather than simply watch it drift. Clear price progress matters too, because healthy momentum should still be making meaningful forward movement instead of stalling. And often there is a fresh catalyst behind the move, such as earnings, guidance, news, or an analyst upgrade. These elements do not guarantee success, but they tell you the move still has energy and sponsorship behind it. If several of them are missing, caution becomes much more appropriate. Fading momentum often reveals itself through several warning signs at once. One of the most common is volume shrinking even as price continues to rise, which suggests the move is running out of fuel. Long upper shadows on candles can show rejection near the highs, meaning buyers pushed price up but could not hold it there. RSI turning down from elevated levels is another clue that momentum is tiring. A shrinking MACD histogram can say the same thing in a different language. The move is still positive, but less forceful. One warning sign may only call for caution. Several appearing together often mean the better decision is to stay out. A stay out checklist can help turn this judgment into a repeatable process. Ask whether volume has risen over the last 3 to 5 days, because healthy momentum usually attracts more participation, not less. Check recent candles and make sure they are not showing repeated long upper shadows. Look at RSI and ask whether it is above 75 and still stable, rather than rolling over. Then check the MACD histogram to see whether bars are holding steady or expanding rather than shrinking. Finally, ask whether a fresh catalyst is still supporting the move. If several of these boxes are missing, the stock may look strong visually, but the quality of the setup is already fading. When the evidence is weakening, standing aside is a valid and often smart decision. A stock can keep climbing for a little while even as volume fades, recent candles show rejection, and indicators soften. But that does not make it a good trade. If RSI is declining after a strong push, MACD is weakening, and there is no fresh catalyst left to sustain interest. The risk-reward picture changes. Strong-looking price alone is not enough. One of the most useful disciplines in momentum trading is learning that passing on a setup is part of good execution, not missed opportunity. A trade you do not take can still be a good trade decision. You do not have to force an entry just because a stock moved fast. Often the better opportunity comes after the chart resets. A pullback into support can reduce extension and give the stock room to rebuild momentum. If volume returns and price regains strength from that area, the next entry may be much cleaner than the original chase, and if the setup stays weak instead, you simply skip it. That patience protects both capital and emotional discipline. In momentum trading, waiting for a better setup is often a skill, not a delay. Consider Solar Tech rallying from $25 to $30 in 4 days after a major government contract. Strong volume supported the early move, so the momentum was believable at first. But on day 5, the stock made a new intraday high and failed to hold it, leaving a long upper shadow. Volume dropped 40% from the prior day. RSI slipped from 82 to 78, and the MACD histogram stayed positive but began to shrink. That is a classic cluster of warning signs. Price still looks elevated, but the energy behind it is fading. If the stock then drops to 28 the next day, the value of staying out becomes obvious. The chart was not saying buy the breakout. It was saying momentum was tiring. A strong practice exercise is to review recent sharp rallies and ask whether the latest phase still looks healthy or already looks late. Compare the most recent update volume with the heavier volume earlier in the move. Study the latest candle and see whether it shows rejection through an upper shadow near the highs. Then check if RSI is above 70 but curling down, and whether the MACD histogram bars are getting shorter. Finally, ask whether a fresh catalyst is still clearly present. This kind of review trains your eye to separate genuine momentum from late-stage momentum. Over time, that skill can save you from many low-quality trades. Many momentum fade mistakes come from reacting too quickly or from using too little evidence. Some traders assume every pause is a fade, which can make them overly cautious and cause them to miss valid setups. Others do the opposite and buy simply because price dipped a little without waiting for proof that momentum is rebuilding. Chasing moves with no catalyst is another common problem. especially when fear of missing out takes over. Relying on RSI or MACD alone also creates trouble, because no single indicator can tell the whole story. The better habit is to use a checklist, require multiple signs to line up, and let discipline overrule FOMO. That restraint is a core part of successful momentum swing trading.